This is the IBJ Podcast for the week of July 22, 2024, brought to you by Taft. I'm Leslie Weidenbender in this week for Mason King. Anyone who has looked to buy a house or a car or anything that might require a loan knows that the Federal Reserve's action over the past 2 years to try to control inflation has had big impacts on the cost of borrowing. Consumer rates have dropped a bit in recent months, but they're still higher than many Americans have learned to expect. So I sat down with IBJ personal finance columnist Peter Dunn, also known as Pete the Planner, to learn more about interest rate policy, what that policy means for businesses and consumers, and what to expect over the coming months. Here's our conversation. Pete, thanks so much for joining us today. It is always fantastic to have you.
I'm not going to say I don't miss Mason, but I'm pretty excited to be with you, Leslie.
Well, thank you very much. We talked a little bit ahead of time. We're going to go a little high school, old school here, in part because this is not a topic that I can claim to be really smart about, and that is interest rates. Of course, this is huge news right now where interest rates are. They feel very high. I know that is a relative term, and we're going to talk about that. But just to set the scene, a 30-year interest rate today is about 7, and I'm talking about a 30-year fixed rate, is about 7 to 7.5%, maybe even a little less at the moment. Car loans are anywhere between 5% and maybe 13%, depending on your credit. Wallet Hub says credit card rates for new applicants range from 5.75% to what I thought was a ridiculous 36%, with the average at a whopping 23%. Do those sound in line with what you're thinking?
They really do. That for credit cards, 19.99 is very typical. Car rates, 8.5%, 9% for sure. And then 30-year mortgage, like you said, in that 7 range. Let's also acknowledge that there's the savings side of that. So the things we pay, well, how are we paid? A high yield savings account may pay 5.25%, 5.5% right now. And this is an environment we've all lived in the last couple of years. And we've kind of grinned and bared it because we wanted inflation to come down. And now we're sick of that. And inflation feel like it has pulled back a bit. So what I'd love to do in respect to my high school econ teacher at Pike High School, Cal Ewing, is show you what I learned from him as to what happens when interest rates go up, which we've all just lived, and what can we expect when they all go back down? Is that fair? Can we do that?
I am in love with that idea. So take it away.
I just have to say, Cal Ewing, he used to mispronounce words on purpose, and then he'd say, I mispronounced it. As a 17-year-old kid, it was really the funniest thing I'd ever heard. So shout out to Cal Ewing. Okay, so Leslie, let's talk about why the Fed raised interest rates.
Let's start really basic. What's the Fed?
Okay, so the Fed, and by the way, as I go through this, people are going to disagree with me because it starts to turn into a political answer. It's what it's meant to do. They set monetary policy in our country. So the Fed conducts monetary policy to promote growth, to stifle inflation and those sorts of things. And so it's the Federal Reserve Board. And if you ever want to get someone really worked up, ask them whether their work is effective or ineffective, and then just sit back and watch. And it's a good time.
Well, at least we're not debating that today.
Oh, no, it's we have the wrong drinks in our hands to do that. But what they chose to do is, because inflation was crazy, we had our economy had overheated, so to speak. They increased interest rates to encourage savings. Okay, so they want people to stop investing, which sounds crazy, and save. So savings to some degree is the inverse of investing. I know that sounds strange. And savings is also the inverse of spending, right? So if interest rates are low, then you're not going to save your money because you're not getting paid very much. So it forces you to invest. If interest rates are high, you say, well, why am I taking risk in the market when I can get 5% on my money? So that's one element of this.
Got it.
Beyond that, when you increase interest rates, it strengthens our currency abroad. Sort of it wasn't the reason the Fed increased interest rates, but it's like a sub effect of it all, is that it strengthened our currency. And then ultimately, though, it is meant to curb inflation by discouraging people from spending money. The more people spend money, the more demand there is, the more it affects supply, and then inflation can go wild. Again, editor's note, which I shouldn't say since you're the editor.
No, you're good.
How often do you say editor's note? Just all the time since
I
you're the
don't,
editor?
I almost never say it, but I write it a lot.
You should say it all the, if I were you, I would say it all the time. Anyway, editor's note for you to say. What's interesting about all of this with going to try to control inflation is we specifically wanted people to stop buying stuff, right? And that is a really fascinating thing. We want our economy to be good. And as the political season is here, we're like, well, economy is bad. It's like, well, our economy is currently designed for people to not buy stuff by definition. And that's strange to hear.
It is. It's especially interesting because we, of course, are always reporting or posting stories about, how this company did, or what their sales look like, or what was the holiday spending? Was it more or less, as a measure of how the economy is doing? But like you said, the Fed is taking action, or has been taking action, that would discourage us from making those numbers higher.
I had someone email me recently about a housing decision they were trying to make. And they saved for like 30 months to save for this down payment on a home. And by the time that 30th month rolled along, Leslie, interest rates had gone up so much that their price range of what they were looking for was now impossible because the monthly cost was so high. So in that moment, the Fed encouraged a person to save and take advantage of the high interest rates from their bank, yet discouraged them from spending that money because they couldn't afford to leverage that money and borrow and buy a home.
This has been a big issue for home buyers right now. Huge.
I will note the last Fed meeting, I saw an article the other day, this idea that there's 100% certainty, which that's a fool's errand, as we both know, 100% certainty that Fed rate will fall in September, right? That's the idea. That generally means that the mortgage rates have already priced that in. So you did see interest rates tick down a little bit in the last week for a 30-year mortgage. I think it went down to like 6.87. And there was an increase in mortgage applications by that eighth of a point bump.
Wow.
Which is sort of wild.
Well, at some point, I want to go through what those changes in interest rates mean to an actual payment, but we can wait on that while you sort of give us more basics.
All right. So here's what's going to happen when interest rates start to come down again. And I'll go big picture first. The housing market should explode, and explode in a good way. Explode can mean good or bad.
Depending on what side of the coin you're on, too.
Yeah. Okay. So it will become a seller's market once again, because anytime money gets cheaper, and when you hear money gets cheaper, it means it gets cheaper to borrow. That means interest rates have come down. More buyers are in the marketplace. And anytime there are more buyers in the marketplace, and supply doesn't necessarily change, then it drives prices higher. So more people can afford that $1,500 mortgage payment, or maybe I should say it differently. More people can afford that $300,000 home because maybe now it fits into their $1,500 mortgage.
Because the mortgage payment, right? Because the mortgage payment is less than it would have been.
Now there's sometimes there's really cute personal finance phrases. I generally don't come up with any of them, but I like to appropriate them. And there's one out there that says, marry the home, date the rate. Have you heard this one?
I have not. Please give that to me.
Feels like something you'd watch on Netflix when you run out of everything else to watch. It's called Date the Rate. So when you think mortgage rates are going to fall in the near future, which is as relative as it gets, you would purchase the home you want to purchase, knowing it's unaffordable for you right now, theoretically. But what you're going to do is you're just going to refinance when the rates fall. So you're dating the rate. You're taking the current rate, and then you're going on another date with another mortgage later by refinancing that.
That does not seem like the kind of thing you would suggest people do.
You and I have known each other for a while now, haven't we? I don't love, personal opinion, whatever disclaimers you have to throw on this, I don't love adjustable rate mortgages. I don't love the idea that especially when interest rates are really low, that you say, yeah, but I want it to be even lower so I can afford this house that I otherwise couldn't afford. Because what happens is exactly what's happened. And that is that After that introductory period, which is often 3 to 5 years, usually 3, then it sets to the current rate. And that's what has happened for the people that got ARMs in 2021, is that now they've reset and their mortgage payments have gone up, Leslie, like $1,000, $1,200, $1,800 a month. And who can do that?
The vast majority of people would not be able to absorb that.
However, if you really believe, don't act on this, anybody, but if you really, really believe interest rates are going to come down and you want to get a 3-1 mortgage and you find the right one where it will reset down, ratchet down to market, it's not a terrible thing to do. But frankly, what I'd rather do is just get a normal mortgage and not have it be adjustable and then just refinance later if you wanted. And here's the strange part about all of this. When rates went down last week, there was tons of refinance applications, not just new mortgage applications. I said to a colleague of mine, because these are the sort of nerdy things people talk about in an organization like mine, I said, that is the weirdest thing, that with an 1/8 of a point bump, people are refinancing. It's like the refinance costs aren't worth it at that point. They got to come down a little bit more.
How big of a drop does a percentage rate need to be for a refinancing to be for the fees and everything for it to be worth it?
There's a couple factors. How long are you going to stay is the number one factor in that. Of course, there's the closing costs. Back in the day, I used to love it to be a point.
So falling from 7% to 6%.
Correct. However, I mean, you could probably get away with it at 3/4 of a point, or what's called 75 basis points. You could totally get away with it that way too.
Got it. Okay.
You know what's weird though? I mean, we got into a period of time where rates fell off so much, and without getting ahead of myself too much, I think I refinanced from like a 5 to a 2.5 or something like that.
I remember refinancing from a 7.5 to a 5.
2.5 point savings.
Yeah.
So your cash flow got a lot better, or you even took some years off your mortgage.
Exactly. I mean, yeah. I went from a 30 to a 15.
Yeah. So I think what is going to happen is this ultimately is going to have a lovely impact for the spring. I'm also ignoring the election, by the way, because I don't really want to get into that. But let's just say we live in a vacuum. In the spring of 2025, you could see a huge boom in the housing market if interest rates fall in September and then they adjust them 1 or 2 times by the time spring rolls around.
And so when you say adjust 1 or 2 times, are we talking a 1/4 point each time usually? Is that what you're thinking?
That's what I'm thinking. Whether that's an intelligent thought or not is certainly up for debate. But I do think you're going to see 1/4 point. I don't think they want to have to like go back the other way if they're too aggressive. The ubiquitous use of they is just so great. I just keep going they. I don't know why I'm doing it. But alas, I think they will do a 1/4 point.
And you said earlier that the mortgage company, the banks, the folks who loan us money have already baked in some of this interest rate cut that they're expecting.
That's the idea. Yes. I mean, interest rates, the idea that they could fall or rise can get baked in sooner than the actual move of the rate itself. Also, what's going to happen when interest rates come down is that all these businesses that have been laying off and have been shrinking and have had to make really hard decisions, well, their decisions get a lot easier because the cost of capital, the ability for a business to grow via borrowing, it gets a lot less expensive. And so that is what leads to GDP growth. That's what leads to jobs. Typically, when interest rates go down, employment goes up. When interest rates go up, unemployment goes up, right? And so people love low interest rates. I mean, that's the name of the episode. People love low interest rates.
Let's take a break to hear from our sponsor. This is the IBJ Podcast.
Taft, today's modern law firm. With more than 800 attorneys in 8 primary Midwest markets and the District of Columbia, we provide solutions to the business issues facing middle market and emerging companies alike. We do this through a highly collaborative and inclusive team approach. Taft, the modern law firm. To learn more, visit taftlaw.com.
Welcome back to the IBJ Podcast. I'm IBJ editor Leslie Weidenbender, in this week for regular host Mason King. I'm talking with personal finance columnist Peter Dunn about interest rates. So one of the things I didn't know before I started working at a business journal, and probably most of our listeners know this because they are business executives. However, I still think it's worth mentioning that companies don't just borrow when they have a big project to do or they have some big expansion they want to do. Many companies are borrowing all the time as part of a cash flow program. Do I have that right?
Absolutely. I mean, from the simplest things of sometimes your clients don't always pay on time, so you got to smooth out the bumps, to the concept of leverage. Here's another way to think about this. Even private equity firms borrow consistently because they use that leverage to get multiples on their investment. So, I live in the world of startups, right? I'm a startup CEO. That means that the venture capital world, which is on the spectrum of PE, it will start to boom again when interest rates come down because of that borrowing component to it as well. So let's go back to the election for a half second. No predictions, no opinions, but what could happen is that if these interest rates start to fall, the economy gets hot. So this is already in motion. And it is not, you can't necessarily attribute Fed rate cuts to the current administration because it's the Fed. It's not the current administration. What could happen this spring? We're going to have a president or a new president or whatever. They're going to benefit from what is happening right now. And we all get to hear them go, the second I became president, the economy took off. It's already happening. And so I for what it's worth, I find that to be interesting.
Absolutely.
All right. So other things that are going to happen as well. Consumers going to start buying more cars, start buying more cars, buying more houses. They're going to stop saving money. They're going to move their savings into the market to some degree, that second or third tier. And so the market could then boom. You're hearing this, and it's probably the people are listening. They're going, well, why doesn't the Fed just lower rates anyway? Because when this gets out of control, like it did in 2021, and I'll explain that in a second, inflation occurs. So, Leslie, we've talked about this in the podcast before. I think I talked about it with Mason, but I want you to go back to March of 2020. So what happened from March of 2020 through December of 2021? The average family of four received $12,800 in government stimulus.
That's an amazing number.
It is an amazing number. And I'm not here to say whether it was a good idea or a bad idea or whatever, but here's what happened. When you pour that much money into the economy, it overheats. People hear overheat and you don't really know what it means. It just means it just runs too rich. And that's what happened. Now, people could make a good point. I was going to say argue, but it sounds negative. They could make the point that corporate greed led to inflation, and sure. And not to be dismissive.
Of course, everything is a combination of factors. There's no doubt.
Yeah, with so much money going into the economy, that's why it can overheat. So that's also why interest rates can't just fly down, because if they do, consumer confidence soars, which again sounds like a good thing. But when consumer confidence, here's what I know as a personal finance person. When consumer confidence soars, people make really dumb decisions because it's like this existential like dopamine hit where they're like, let's go. And they do real dumb stuff. When consumer confidence is really low, that's actually when people make the best personal finance decisions imaginable. And yet in our minds, we feel worse because of that, which is fascinating to me.
It's a fascinating psychology.
It is. So that's what I think is on the horizon. I think that people will not only save less money, they will invest more money, and they will spend more money. And good times are ahead with the economy because we slayed inflation.
So there's a lot of talk about, inflation and prices are pretty high right now. I mean, in terms of what you pay at the grocery store, I mean, it's a part of the election where prices are, auto prices are very high. Do you expect when the interest rate drops, are any of those prices going to come down? Are these prices now the new floor?
Is it fair to say I wonder that too? I don't think at the grocery store you're going to see a lot of prices change. Now, I will note, if let's say you have a food producer that has to borrow money as part of their operations and they have to pass those borrowing expenses on through the product cost to the shelves, and then those borrowing costs go down, they can either A, lower prices if they're in a competitive situation, or B, get while the getting's good and take those margins for themselves. So I don't think those really come down. I think what you could see is when buying gets fun again at the car lots, is you could see a lot more great lease deals or great interest rate deals that you just don't see anymore. That
Sure.
129 a month lease, or the 0% interest for 5 years.
Yep.
We're nowhere near there, by the way, but those start to come back.
So let's talk a little bit about what the difference is in mortgage rates, if that's okay with you.
Let's do it.
What kind of impact these make? So I did a little bit of, I used some online calculators. Online calculators are one of my favorite things. So I looked at a $400,000 30-year fixed rate mortgage. I would not ever take out a $400,000 30-year fixed rate mortgage. However, I think it's pretty normal these days.
It is pretty normal these days.
So I looked at, so in 2021, you could have taken that out for 3%. If you had good credit, you could have had a 3% interest rate. That would have equaled a $1,686 payment. Now, of course, that's not property taxes. That's not a lot of other things, but mortgage payment alone, $1,600.
You know what? And I know that we're furthering the point here, but if I may, you think about what rent is now.
Yeah.
And then people who are renting right now, trying to become a homeowner, and they hear that, it just sends you wild.
Absolutely. To rent a 2 or 3 bedroom apartment now costs $1,600 a month easily. So
absolutely.
5% interest rate, 2022, we had a 5% interest rate. That at $400,000 was a monthly payment of $2,147. So a jump of about almost $500.
And let's contextualize that for a second. That's, let's call it $6,000 a year after taxes.
Okay, so I figured 7.5%, which I probably should have done 7, but I did 7.5, which I might have done that because, like I said, that's what I bought my house at back in 1997. I bought it 7.5. That would, for the $400,000 mortgage, that would be $2,797, which is more than $1,100 more a month than at 3%. That's a lot of numbers I'm throwing out, but
never mind what happens with property taxes and insurance. And let's also not forget that sometimes interest rates can indirectly impact those, depending on how your state's going. They may have a property tax cap, or insurance companies, depending on global warming and loss, they may have challenges. So yeah.
So I looked at a car loan, $25,000 car loan over 60 months. I'm assuming you don't really recommend anyone take out a 60-month car loan, but that's what I did it. 5-year car loan, 3% car loan at $25,000 is a $449 payment.
Now, this is totally anecdotal, and it's so relative. That seems that doesn't sound bad.
It is relative, and that was what I thought too. Was that doesn't sound like the end of the world.
No, it doesn't. But it's about to get worse. Tell us about it.
5%, you get up to $471. And at 10%, actually, I have to admit, these don't change as much as I thought they would, because it's $25,000 versus earlier we were talking about $400,000. So $25,000, 10% is $531.
Again, not that bad. It's also the amortization period, right? If if you were to run a 3-year car loan and then an 8-year car loan and you make that part of this process too, then you can start to see those really big jumps. Because Leslie, here's what happens when a person cannot afford a payment given to them at the dealership in that very awkward moment. Then they change the payment terms to be able to afford the payment. And then that's where it sort of sometimes doesn't go in your favor.
And then the total amount you pay just gets insane. And then of course you've got a car that may or may not last the length of your payment schedule. I mean, it's a scary thing.
Here's another side of this. Let's not that we're not thinking positively, we're thinking realistically and having a conversation, but let's take an IBJ reader scenario here, right? Let's say you receive a bonus or an inheritance, or you find a tire on the side of the road filled with $100,000 in cash. This is pretty common.
Yeah. Oh yeah. That's what happened to me just last week.
I
So
believe
I'm glad we're addressing this.
I think it happened to Peter Brady in like season 3. Anyway, so this happens. And you're like, okay, it's an extra $100,000. I'm just going to set it to the side, and the $416 a month at 5% interest that's generated is just going to pay for that car payment we just talked about, right? It's just going to pay for that car payment. So what happens when interest rates on a savings account start to fall back to those periods? Remember when it was like less than 1%?
Yeah.
And it felt insulting. What happens then? It's like, okay, well, now you're getting $60 a month. And then so you don't save the money, you either spend it or you go and you try to invest it and take more risk.
So, but at some point, maybe you just pay for the car in cash, right?
Well, I mean, yeah. And plus you got an extra tire that you found on the side of the road that the cash was in. You don't even need to buy a spare.
So let's go back to the very beginning. You said it's easy to get caught up in all the spending, talking about what the negative impacts of higher interest rates, but you talked about savings rates. So what are you expecting to see soon with savings rates?
When I talk about savings rates, I talk about the amount, the percentage of a person's income that they choose to set aside. And I don't want to get weird here, any weirder than I normally do, but I do find there's a difference between not spending and saving. Maybe not worth exploring. Anyway, I think that they will come down. So what happened in the fall of 2020 when we were still seeking normalcy and those sorts of things? Pent-up consumer demand bubbled over. People just couldn't deal with it anymore. Leslie, I was making my own hamburger buns at one point because I had the time. But at some point, people just were like, I gotta go travel. I gotta build onto our house. I gotta go to the mall.
I did all
that
those things.
Same. And it's gonna happen again. Like, it's coming. Spending has slowed pretty significantly over the last couple quarters. And the timing always works this way. If we go one quarter rate point cut, a lot of words point there, in September, and then we have another one a little bit later in the fall as we lead into the holidays, people are going to be feeling good, and that holiday spending season, absent the presidential election, is going to have people feeling really good.
And of course, what people will earn on their savings accounts and assuming they're in a decently high interest rate savings, I mean, that's going to, as the interest rates start going down, that's going to go down too, which is, of course, also there's not just incentive to spend, but there's a lot less incentive to put money in those accounts, right?
Yeah. And what's interesting is I find that those rates tumble faster than the borrowing rates.
Of course they do.
And it feels punitive. And so you are offended. It's like I was saying, like when it's less than 1%, do you remember those times and you're just like, why even? What am I doing? And that happens pretty quick. I mean, psychologically, if we do not feel like we're benefiting from that discipline, and then we're not going to employ that discipline.
And are you already seeing that some of these saving account rates are dropping already?
I don't look at them a lot, but I haven't sensed it.
Yeah.
But I feel like it's coming soon. I absolutely feel like it's coming soon. So maybe that's something we keep our eye on in the next 60 days or so, because if the rate cut's coming in September, that's on the horizon.
Put your personal finance hat on, your helping people make good decisions hat. what would you urge people to do as they start to see borrowing get cheaper, as they start to think about how they want to go out and spend again? What are your recommendations for people?
Remember how I said when people stop saving, they kind of do two things. They either start investing because they're willing to take risks to get better returns, or they start spending more because they can enjoy for less. Just choose investing. like if you're going to change a behavior because of the disincentive of low interest rates, or the incentive of low interest rates, then do something positive with it. And let's go really into the nerd weeds here. There's this concept that a few years ago I explored called power percentage, where it's this idea.
Yeah, I remember this. Yeah.
Yeah. It's like, what percentage of your income is increasing your net worth on a monthly basis? Like, what percentage of the usage of your income is increasing your net worth? And so, Leslie, the truth of the matter here is, look through that lens when comparing, okay, now I'm incentivized or disincentivized behavior-wise to do something different. Does your power percentage stay the same, or does it go down, which would be bad because now you are more dependent on your income? Because that's what this really boils down to. Financial independence or retirement or whatever people choose to call it is about breaking the dependency on your work income so that you can take a lesser income, which is often this passive income that we have in retirement. So when you feel the best is when you're usually going to make the worst decision. I'm a buzzkill. Mason knows this. I'm a buzzkill.
It's so true, though.
It's so true. That's why on payday, people make terrible decisions.
Yep.
The day before payday, pretty good decisions, right? So when you feel the best, you should start going, wait a second, I can't do something dumb here. I should probably take the advantage I have and sit on it.
That's why you have to have money going straight from your paycheck into your savings account before you ever see it hit your checking account, right?
I fully endorse that.
I am going to link in the show notes to the power percentage column that you wrote. And I think you did a podcast about it too with Mason. And if that's the case, I will find that and put a link into that as well. Pete, thank you very, very much for joining us today and going through all of this. I know even people who know quite a bit about this, I feel like they'll gain something from this podcast. So thank you.
Well, it's my pleasure. And you get to field all the emails instead of Mason this time of how wrong I was. So enjoy those emails.
Oh, thank you, Pete. Thanks again to Pete for joining us this week. You can read his personal finance columns at IBJ.com and every other week in the printed issue of IBJ. Also, just last week, IBJ Media named Pete to the 2024 Indiana 250, a list of Indiana's most influential business and community leaders. You can see who else made the list by going to Indiana250.com and see photos of our Indiana 250 event last week, which featured remarks from former Vice President Mike Pence. And speaking of vice presidents, there's been a lot of news since I recorded my conversation with Pete. President Joe Biden has dropped his re-election bid and endorsed Vice President Kamala Harris to replace him on the ticket. But that decision will ultimately be made by the Democratic National Convention delegates. You can follow the twists and turns at IBJ.com. Thanks for joining us. Mason King will be back next week.